Well, some of Canada's big oil players, including Canadian Natural Resources, reported their results. And for a recap, let's check in with Josh Young, Chief Investment Officer with Bison Interests. Josh, thanks so much for making time for us.
Absolutely. Thanks for having me on.
Let's kick off with Canadian Natural Resources. We've been talking about it throughout the show today, but they made an interesting change to their plan for returning free cash flow to shareholders when their debt gets to a certain level. So they made that level be $10 billion now. So it's a bit of a change when they're going to start returning. What do you make of that?
Yeah, I think it's really positive. I think what investors have been looking for in oil and gas companies are signs of capital discipline and return of capital where appropriate. And so this is a great sign. And I think it's going to be good for Canadian Natural in terms of their cost of capital. And I think it's good from an overall supply demand perspective that large companies that are delivering great results like Canadian Natural are shifting to returning all of that capital back to their shareholders.
And how does Canadian Natural compare now to some of its peers when it comes to its dividend? Because it increased its dividend to 90 cents per share. And I think that that's outpacing some others, isn't it?
Perhaps.
Or at least the yield. Yeah.
Yeah, I think it's interesting, right? So it's an excellent company, but excellent companies that are well known as excellent companies tend to be priced as such, and so it has a comparatively small yield along with a few other really excellent large Canadian oil and gas producers. So on one hand, it's great, and it's great. On the other hand, you sort of have to pay for it.
And just with this quarter for Canadian Natural, they talked about the impact of the, extreme winter weather and what that did to some of the equipment. They needed to do extra repairs on the equipment. We often think of as sort of one-off, but it's not really, right? When we do have extreme winter weather, any given year, what did you make of that impact on the company in the quarter?
Yeah, I think the Raymond James analyst put something out on this where, E&P companies in Canada and integrateds tend to sandbag their numbers a little, especially for spring breakup. But even for winter, there's some expectation that there could be some disruption. Incidentally, oil prices actually were hurt a little worldwide because of the relatively warm winter here in the U.S. and in Europe, because there was less heating oil and fuel oil demand. So there's sort of this interesting Canadian Natural maybe got hit twice, once from the weather for themselves and then also from an unseasonably warm winter for oil prices.
Tourmaline also reported. What did you make of Tourmaline's quarter?
Yes, same idea. I mean, they're producing more on the gas side. Just great results, very impressive capital efficiency. Also similar idea in terms of pretty high valuation relative to smaller peers. And you know what you're getting with Tourmaline, and they're really excellent, but it comes with a price. And
you've also been looking at Crescent Point with a sort of takeaway of something bigger for the industry. What was it that caught your eye there?
Yeah, I mean, super interesting. So the Clearwater companies innovated multilateral open hole wells, basically cheap ways to get lots of exposure to the reservoir a mile or so down in the ground without having to frack wells and just getting the maximum exposure for the minimum price. And Crescent Point has now tried that approach in their Bakken play in Saskatchewan, and they've had success with it, and it looks like they're identifying over 100 locations. I don't own the stock, but it's very interesting, and I think it's a part of a larger trend where there's other areas where this technique is going to be applicable. And I think there's going to be it looks like a shift a little in terms of capital and in terms of value for larger original oil in place pools that are similar to the Clearwater, similar to the Bakken. And so I think it's an interesting sort of in real time puzzle as an equity analyst trying to figure out who else has large upside from this success and this innovation.
That keeps it interesting, a real time puzzle there, Josh. Let's also touch on Baytex, because Baytex is making this acquisition of Ranger Oil, so a U.S. company. What do you make of that acquisition?
Yeah, so it's interesting. So actually, Baytex came out with their announcement, and then Journey came out with a equity raise for a flow through, and both of their stocks fell considerably on the day of their announcements. And I guess I would contrast the two, where Baytex hadn't really been guiding to making large acquisitions, and their share count increased dramatically, while at the same time they weren't buying assets that were quite as good as their core Clearwater or even their existing non-op Eagleford position. Journey, on the other hand, has done great acquisitions so far, and the market didn't treat their equity raise so favorably in the day after the announcement. But they're essentially just clearing the decks and getting ready to do another deal. And based on their track record, it seems likely they're going to continue to high grade their asset base and do deals that the market's going to treat more favorably. So it's sort of interesting to see those two happening almost at the same time with a similar market reaction, but potentially different outcomes over the medium term.
I'm also curious to get your thoughts on small caps, because we've got a graph that you provided for us as well that hopefully we can put up. It's titled Return on Select U.S. Exploration and Production, just for the control room there, U.S. Exploration and Production companies. There we go. And we're looking at Vital Energy compared to small cap equities and large cap equities. Can you tell us a little bit about what we're looking at here?
Yeah, so this is a return on capital employed metric using, I believe it was consensus numbers. And so what's interesting is I was pointing out the very high valuations of, for example, Canadian Natural Resources and Tourmaline versus smaller similar competitors. And one of the rationales is those are excellent businesses that deliver very high returns on capital employed. And so Vital is an example. It's a company that I own some stock in here in the US that actually it's interesting. There are some of these small companies that have really high returns on capital employed, but still trade at much lower valuations. And so one of the interesting things I think about small caps is you can find these companies that have little coverage or where people don't really understand them. And, for example, Vital, they had an excellent report too, unlike a lot of the US shale companies, which showed a higher percentage of gas and disappointing oil production results. Vital actually came out and beat their oil production numbers versus expectations. And so it's sort of interesting, I think, and I think people just don't fully appreciate this. When you go down to this sort of smaller size level, there are lots of these sort of interesting underfollowed opportunities with companies, even when their peers are doing poorly or missing, they can beat and also show accounting metrics that are very rare for small companies and that historically have attracted pretty high valuations.